Look, Jared's a thinker.
Jared is fine being sleeps on
Oh, that's not working.
I don't sleep on the floor. I sleep on my mattress. I just put the mattress on the floor.
You don't have a bed frame?
I have a bed frame. I just don't use it for my bed.
What does your roommate think of it?
It makes you the genius.
Everything. I have like the Okay, I have like the desk, bed.
So what's up?
I submitted a term for your financial markets and modeling class.
Yeah.
And it was the 7th term. How likely will I be able to take
It depends on how you write your perm.
Okay.
It's because that's where the competition is.
Okay.
Okay, I get a lot of perms.
Last year I had
Yeah.
my mattress on.
That makes sense.
So you gotta be motivated.
15 minutes ago.
Okay.
And did
Okay.
not wait that kind of time, so.
Will you be accepting firms for
Yeah.
financial modeling?
Make sure it's well motivated.
What'd you say?
Make sure it's well motivated.
Oh, okay. Like,
Gotta figure out what that means.
okay.
A follow-up question. When will we know that we got into the class?
Oh, it'll take at least a week to 2 weeks because it'll take me that long to process them. Plus, I have to make sure I get all in that are going to be submitted.
Yeah.
Okay, so it's got to be like an alternate on your registration.
Yeah.
Okay, I have to start the class.
Yeah.
We're on YouTube Live. Okay, here we are. Got to calibrate myself to you. We got some side bets going. Will this classroom last until the end of the semester, or will we have to simply move off campus to complete our work? We're down to one slide projector. The batteries were dead here today. The power went out in Parsons, which happens, So, of course, I've got power supply backups galore in that office. I can run for days. And so I locked everything down and continued the work I was going to do. And then there was a big bang on the door. The klaxon was going on out in the hallway, but I've got these special Sennheiser headphones that blocks outside sound. So I was listening to the Goldman String Quartet as the building burned down. But I was informed that although the power supply was back on, that there was a piece of engineering equipment that was having trouble spooling up. And I got the impression that it might explode and kill us all unless we evacuated the building. And even from the absurdity of Harvey Mudd College, that seemed to be a really stretched explanation for why we had to evacuate the building. But I just went home and took a 2.5-hour nap, and I just got back, and the elevator wouldn't work, so I had to use the library's elevator, and now we're in here in the state of disrepair. So if we're lucky, everything may just barely hang together when we get through this semester. Then we can come and rebuild it and start the next semester. Oh, there we go. We lost that one too. And try to get through that. Oh, yeah. Oh, they're fixing it. They're fixing it back there. Okay. Our capable crew. Yeah. Okay. So now this lecture is quite important because I'm talking about a really key subject about investment options that people with retirement accounts take without knowing what they're getting into. Because the ETPs that we're talking about today are attractive investment accounts, or for retirement accounts, and they're unsuitable for that. And most people fail to understand why they're unsuitable for that. But if you pay close attention to this lecture, although it's a bit complicated in why they're unsuitable, only there's 2 or 3 major points really that emerge from this that you can remember, I think, to understand something that is only understood by a tiny minority of the population. And again, the motivation for this is it does not maybe matter to you so much now that you get your investment decisions right, but by the time you're married and have children, it'll become more important to you because figure by the time, say 20 years from now, your children are just approaching college age, you've got to understand that unless you're a billionaire, Harvey Mudd will be unreachable to you because it'll simply be too expensive. Currently, you have to be in the upper 10% of the income group to attend Harvey Mudd, but by the time your kids are ready for college, you'll have to be in the upper 1% of the income group. So that means you will have to have made a whole series of really wise investment decisions to be able to afford to send your college to your child to a college that specializes in preparing young men and women for starting jobs at Google and Apple. And that's expensive to do. So you'll have to be able to draw upon resources such that you can pay the tuition, which at the current rate, you take 77,000 and multiply that times 1.035 to the power of 22, and that's what the tuition will be when your kids are ready to come here. And so you ask yourself the question whether you're going to be able to do that. And if you make bad investments in exchange-traded products, the answer will be no. So that's why this lecture is important for you. And this is specifically about that sloppy connection between ETPs and futures contracts. The last lecture ended because I had a lead-in just like I had right now, and that actually killed 5 minutes, and I didn't get to the end of the lecture. So this was the slide that we missed from that, left over. And one thing that if you trade these commodities like I do, just for speculation for the largest part, one thing that I was pointing out in the book that I'm only mentioning here in summary in the slide, in the book I give the natural gas inventory example of why this matters. When we talk about tangible and storable commodities like crude oil and natural gas, wheat and copper and so forth, it is the case that the prices that you're looking at are fundamentally determined by supply and demand conditions, just that. And so if you have a feel for that, for whatever reason you might, then you're going to understand where price directions are likely to take you, and investing in futures contracts can be lucrative for you. Now, if you take a microeconomic theory class, there's this discussion of supply and demand and the like, but you probably realize when you hear that never will you see a supply curve or a demand curve or any sort of empirical exposition of the components of those micro models. You have to rely upon actual data that's out there that might be available, for example, in a large granular data set that can tell you about indirectly what supply and demand are doing. Because as is pointed out in the chapter, and there's even a slide in there that sort of shows the workings of the cobweb theorem in microeconomics, how you get to equilibrium prices, that even if you don't know supply and demand, changes in inventory are a dead giveaway about what's going on in that world. Because the stored inventory is the buffer between discrepancies in supply and demand. So if something is changing in the market and demand is plunging, for example, and producers are not aware of it, and you as a trader are not aware of it, it can become immediately obvious that it's a problem if statistics that show rising inventories are pointing out that those inventories are rising without an explanation. And so people who trade these kinds of commodities pay very close attention to inventory data and deltas in inventory data. I just say that in case at some point you're interested in getting into trading these directly. And I use, again, in the book, the natural gas example as the example of how I trade. I trade off of inventories in natural gas. And if I get to the end of this lecture, and I probably won't, then I'll give you some specific concrete historical examples of that. Now, that was, again, an afterthought to Monday's lecture, the final slide. So let's get into this important stuff. Now, you know that there are delta ETPs out there that track just daily changes. And you know that there are leveraged ETPs out there, both inverse and direct. Inverse meaning moving opposite the price of the underlying, direct moving the same direction. Leverage meaning doubling or tripling the move. Typically, almost always as a delta, though, where if it's a minus 3x delta, we say if the price of the underlying goes up by 1% in any given day, that the price of the futures contract should fall by 3% if it's a minus 3x delta. And so you say, well, how, even at the level of the delta, let alone long term, how can they track that? How can they assure that? How can they make an investment that gives that kind of performance payoff? And especially when I tell you those actually track quite well. Usually, I'm going to tell you the one time when they don't track in this lecture, and that's when the futures contracts are in contango, as we'll see. They track very well, and I'll show you that, for example, USO, which is the United States crude oil tracking contract, has never been off more than 1% on its delta in the last year. So how? Well, it's because they use futures contracts and they use the leverage that's implicit in managing the cash account of their futures contracts. This is very easy to figure out and to remember, and it is well represented on the final exam. Now remember that we said originally that the maximum leverage you can get on a futures contract, which is normally not relevant to us because we don't run at maximum leverage, is equal to the notional value of the contract divided by the initial margin of that contract. And so that'll be a number like 23 to 1. But if you actually trade futures like I do, you're never going to be running your contracts at 23 to 1 because a 4% move will wipe your entire account out. So you're more content to earn leverage of 6 to 1 or 7 to 1 or 5 to 1 or even 3 to 1. So how do you determine that leverage? Well, that's the problem that has to be solved by the tracking delta ETFs, because they are promising, for example, 2 to 1 or 3 to 1, both inversely and directly. And so how are they able to make that promise? Well, it turns out that it's really easy to do that. So if the actual leverage you earn is equal to the notional value divided by the cash in the account. So if you want 3 to 1 leverage, then you have to keep that ratio of notional value to cash in the account at 3 to 1. And that's really all you have to do if you're using futures contracts. So rule of thumb is if you're building one of these things, let's say we want to design an ETP that is leveraged, for example. We know that a long ETP holds long futures contracts, of course, like SPY. Well, SPY is not futures, like USO. And inverse holds short futures contracts, so that's that. For a 1X, the notional value of the contract is equal to the cash in the account. And that's where most of them are. For a 2X, the notional value is equal to 2 times the cash in the account. And for XX or alpha X, like 3X, alpha any number, any integer typically, is notional value is equal to alpha times the cash in the account. Finally, we're going to remember that because a futures contract is actually a contract to buy something in the future, being in the contract is not something you have paid for. It is not an asset, nor is it a commodity, nor does entering the contract, long or short, affect the cash value of your account by virtue of the fact that you entered the contract. It does affect the cash value of your account thereafter through the process of daily settlement. But if you go into a $44,000 British pound contract, like the one I showed you, the one we're in currently, then it does not affect the cash balance in your account when you enter it, and it doesn't affect the cash balance of your account likewise when you exit, except for the settlement for that day's exit. So the asset of an ETP is equal to the cash in their account. It's as simple as that. So when you say, well, what's the NAV of the ETP? Well, that's equal to the total value of the account, total asset value, divided by the number of shares outstanding. So you say, okay, what's the numerator of that, the total asset value? The answer is always this. It's the amount of cash they have on hand. Simple as that. It's the amount of cash they have on hand. Now, we'll look at multiple examples of that in the next few minutes to make sure by example you understand this point. But let's do some financial engineering and build our own ETPs. Years ago, I used to give as a part of the take-home final the assignment that students design Bitcoin futures contracts. And you had to come up with a Bitcoin futures contract design to get full credit on that. And that was long before Bitcoin futures became available, because it turns out it's quite easy to do. And we're going to do it not using Bitcoin, but by using gold. And so we say we want to build 4 gold ETPs. And you say we have a gold ETP, it's GLD. But that's an exchange-traded fund. It meets the SEC criteria for being called a fund because it's collateralized directly in the asset that it represents. Remember that, right? The GLD ETF actually buys physical gold, or to be more accurate, the creation units, when they release them, are paid for not with cash that is then used to buy gold. It's actually paid for with a gold transfer. And remember, we saw the picture of the warehouse warehouse where the gold is physically held. So they own gold, no problem, that's an ETF. But let's say we don't want to own gold, we want to do this with futures contracts, because not only do we want to have a standard 1x long, we want to have a 1x short and a 3x long and a 3x short. So we want to add 4 ETPs to our fund family by doing this. Well, it turns out that it is pretty easy to do. So let's say we want to build 4 of these, and let's say we have $100 million that we want to dedicate to each of these 4. So we'll have an initial ETP that has a $100 million worth of something, and therefore its NAV will be determined by $100 million divided by the number of shares that we issue through creation units. So we say, well, let's make that 10 million shares, and that will allow us to start each NAV at $10 for each of these 4 gold contracts, right? We're saying we're collecting $100 million. We're going to issue 10 million shares, at least eventually, as creation baskets to market makers. And with that, the hope is to maintain the starting price at right around $10 per share. That's the goal. So then we look and see the gold futures contract size is 100 troy ounces. This is last year's example. I don't change it just because the next slide's got too much stuff to change on it. So the gold futures price, which currently is about $1,500, is $1,227.20. Gold spot, which is not relevant to anything we're doing, but we kind of want to know what it is because the futures will converge to the then spot when they expire. The gold spot's a little under it at $1,184, and the margin, which is not relevant to us because we're going to keep cash way more than the margin, is $6,000 per contract. Okay, so when we do the gold 1x long, which we'll call GLD1L, that'll be the symbol for our ETP, then we take the current price of the contract and divide it into the notional value, and that says we can release 815 contracts in the form of creation baskets, all right? Because that'll, given all of this, we're just taking the notional value and the calculating the value of a single contract. Single contract is the gold futures price times 100. And so that says we can buy 815 we can release 815 contracts, and they should track more or less properly if gold tracks the price of gold, if the futures tracks the price of gold. That one's easy. The GLD1S, we do 815 short contracts, same thing, and that has a notional value of $100 million per ETP. Now, if we do the gold 3L, then the difference on this and the gold 1L and 1S, the long and short, is we have to have futures contracts that have a notional value that is 3 times the amount of cash dedicated to that account, right? And that will track 3 to 1. So we say we buy $300,000 worth of the long gold contract, and that entitles us to buy 2,445. Or not buy, we enter 2,445. And you say, do we have the means to do this? We said we had 100,000 per contract, or million per contract. We have 100 million per contract. Yes, we do, because of course the margin is $6,000. And so we have way, way, way more than we need to buy or enter these $300,000 worth of contracts. The margin on 2,445 contracts is 6,000 times that, and that's not very much money compared to what we're trying to do. The point is that we acquire the contracts with a notional value equal to X times the amount of cash that we have in that contract, and that gives us exactly X leverage. So if we want 3 times leverage, then we buy enough contracts to give us a notional value that's 3 times our investment. 2, If we want 2, then it's enough to buy 2 times our investment. And if we want 1, we have basically the notional value of the contracts equal to the cash in the account. Now, when you go and take a look at the prospectuses of ETPs that use futures contracts, this rule is religiously followed. You don't even need to see what they say they hold. You know what they hold by basis of what they claim to track. If we take a look at a 2x negative oil tracker, we know that they are short on futures contracts, and the notional value of the contracts they hold at the time will be exactly double the amount of cash they have in their account, as represented in the prospectus. And we'll confirm that right now. So that turns out to be, you may have to think about this a little bit and do a little bit of the arithmetic to check logically, see if this makes sense to you, but it will make sense to you. It's actually quite a simple rule. Let's take a look at what the rule actually is. So VIS means very important slide, because you'll obviously have something about this on the final. So the NAVs, the ETP's total NAV will equal the total cash value of the ETP's assets, and that is it, and not the notional value of the ETP's futures contracts. They are not an asset, and they don't count in the asset value. The ETP's per share NAV will equal the total NAV divided by the number of shares outstanding, as was our example in our gold contracts. 1x means cash equals the notional value of the futures contracts. And so when the value of the futures contract changes by X% daily, then because of settlement, the total cash value changes by the same percent. Therefore, the total NAV changes by the same percent. Therefore, the per share NAV changes by the same percent. Therefore, the NAV ETP is tracking the futures contract price perfectly. And they don't do it perfectly, but they do it nearly perfectly. They track about with, as I said, 1% error. That's only a problem if the error is cumulative, and usually it's not, although there is a certain circumstance where it will always be cumulative, and that's a special part of the lecture where you can see why logically that would be. So you can say if it's set up this way, like if our gold contract is set up this way and it becomes popular, it will likely track it day after day with no more than 1% error. So long as you're looking not at the cumulative track, but at the daily change, which is what we're promising to do. And it will end up actually that if the markets are stable, it will track it fairly reliably even on the cumulative track. But there are exceptions to that, as we'll see. Now, for the 2x or 3x, then again, the rule is that the cash equals the notional value of the futures contract. So 2 times the cash, 2 times the notional value. So when the value of the futures contract changes by X% daily, then because of settlement, the total cash value changes by 2 times that amount. Therefore, the total NAV changes by 2 times that amount. Therefore, the per share NAV changes by 2 times that amount. And so that is like 3rd year PhD level graduate school introduction on how you build financial engineering at ETP. So you know how to do it. You don't have to go to graduate school. You can work on trying to accumulate enough money to pay your funds to let your children go to, Cal State San Diego might still be affordable. Only have to be a millionaire to go there. Unless Bernie Sanders is elected.
What is
The debate is tonight, by the way. Sorry. I'm for Buttigieg. I've changed my mind. No longer supporting Biden. Okay.
What does it mean when it says the futures delta doesn't necessarily match the futures delta?
What?
The slide says the futures delta doesn't necessarily match the futures delta. Those 2 different things on part E.
Well, no, what matters is the change in the futures price, right? So we're not tracking spot, although this is qualified by the fact, and this is going to be a big deal eventually, that the futures must converge to the spot as the contract expires, and on the final day, the futures price will be the spot for that day. Arbitrage is going to guarantee that. So thereafter, the only rule you have to follow is the leverage rule, and the leverage rule is very simple and very consistent. All right, so here's an example of how these would track. And I'm not going to go through this. If you say, I don't see how these would track, just go back and find this slide and look down at arithmetically and see how it will track. See that this works out, right? So here's some made-up prices for gold, 1227, 1224, and so forth. And so you can see if you set up the ETP in the way that I have specified, and it's designed that way, if the future price does that, then the notional value will do this. That will affect the cash in the way that I've shown, and that will affect the NAV in the way that the NAV is shown. And so you can just go through it and play with it with a little calculator, or set it up in Excel yourself, or write a Python program that'll do it. And it demonstrates that logically the NAV should change by exactly the same percent as predicted by the tracking criteria if you set it up in the way I described. So the 3 short contract, the 1 long contract is easy to follow because it's proportionate, right? But the 3 short contract shows that if the price of gold goes to 1202, that you're going to have a capital gain on that that's actually at the end 3 times the size of the actual capital gain made in gold itself. So that's the way all of these are designed. If we design them, I figured, well, the best way to show them how they're designed is design one ourselves. We're comfortable in our design, and then so let's go check and see if the others look like that. And of course, we could pull in an example of 100 of them, and they would all look like that. So instead of looking at 100, let's look at 5. Here's USO. This is the most famous of the tracking stocks, I would say, these days, okay? Now, assets for USO as of 11/18/2019 stood at $1,247,799. I said that wrong. $1,247,799,896 on 11/18, and that was in their prospectus. Shares outstanding on that day were 104,600,000 shares outstanding, and so their NAV on that day was 1193, and so that's what you would expect to see. Now remember, the NAV is not the price. The price is determined by supply and demand in the marketplace, and so there's always the possibility of that short-run mismatch because the price is determined by supply and demand. But of course, if it gets far away from the NAV, then supply and demand is going to pull it back closer through NAV arbitrage, as we've already discussed, right? Now, here let's take a look at their asset values here. And so they say they have $1,247,000,000. And so what do they have? Well, they have crude oil contracts expiring in January the 20th, and they have 21,838 of these, and the price that says October the 8th, that should say 11/18, sorry. This, again, modifying last year's slide. 5714, and the market value or notional value of that was the 1,247,000,000 and so forth. But they also have cash, and that cash equaled 1,254,000,000. So the instinct would be to say, what are the total assets of the USO tracking stock so we can determine the NAV? Normally, you would answer that by saying, well, it's got to be 1.247 plus 1.254, right? Except you remember, no, the futures contracts are not an asset, and only the cash value is the asset. So when you compare the assets as stated in the prospectus to the assets as stated in their holdings, you'll see that the cash value of the holdings is nearly identical to it's always off by 1 or 2% because they're taken at different times. There's also some categories in there like accounts receivable and so forth that aren't in the holdings account, so they're often off by $500,000 or so. But aside from that, they're identical. So the stated assets appear to be double the declared assets, but that's because only the cash itself is an asset. Because again, when they started with, let's say, around $1.2 billion, and they acquired 21,838 contracts, and they acquired them about a month ago because they roll them every month. And they start rolling about 3 weeks before the end of expiry, and they're done on the last day of expiry, so they're doing constant rolls all the time. Some days when you look at this, because that's true, you'll see 2 contracts there. They're halfway through a roll. Going out of the December's into the January's. For about half the month, that's true. For about half the month, it just has the more distant contract, the January 20. But again, so what they promise to track, if you look at their prospectus, is daily changes in percentage terms, meaning, again, this is a classic delta fund that is promising only to track the delta, because, of course, that's the only thing they can track, because the delta is literally the daily settlement delta. And so they're saying we will track the daily settlement of the futures contracts. Now, what they promise to track is the actual price of oil, which is not the same thing. You know, because the futures contract is not the same as the spot price. So that's why there's going to be an error in there of 1% or 0.5% or 3% per day, because they're not claiming to track the delta of the futures contract that they hold in the prospectus. Although increasingly some of the newer funds make only that promise. They say we promise to track the delta in the nearest term futures contract, which by definition they have to be able to do. So obviously they have a 100% tracking contract. They have a 100% tracking record. So again, I have the part circled from their fund details, daily changes in percentage terms. So you say, well, is this a good inflation hedge? Or is this something to buy if I think the price of crude is going to go up over the next year? Would it be a good idea, for example, to either roll a bunch of short-term contracts for a year, or should I buy the contract that's out there a year? Should I buy the January 2021 contract? Or should I short it? Because that's when the Ford Mustang is going to be released in, I guess, February of 2021. So they short this. Because nobody will need oil anymore, except to oil your door so it won't squeak. And that's not nearly as much oil as is used for gasoline. Okay, so all of them look like this. They all have the same rules. And you'll notice here, you say, what kind of leverage are they getting on these futures contracts? The answer should be really obvious to you. The leverage they're getting is 1-to-1, no leverage at all. Because although they could use 1/20th as cash to buy these contracts, they're matching their cash to the notional value of the contracts. And so they're getting no leverage at all. So if I were to do that in my contracts, if I were to set aside literally $44,000 to go short in a British pound contract worth $44,000, I would be getting no leverage on the bet also. And I could call that a 1x short British pound fund if I wanted to. But of course, if you're a speculator, you're specifically trying to get leverage of, say, 6 or 7-to-1. So you tailor the cash amount to the notional value to where you get that kind of leverage, you see. Okay, now what about 3x short? Is there such a fund? And yeah, of course there is. It's oiled short 3x, okay? Now take a look at what they have. They have futures contracts. They have 4,032 short December 2019 crude oil contracts with a notional value, which is registered as a minus sign if they're short, of $230,388,480, and the fund has a cash position of $76,804,628.75. All right, and they had 5,575 shares out on the day that this was captured just a couple of days ago. So you say, well, what are their assets? Their assets equal $76 million. That's what their assets are equal to. And so you say, well, what's the relationship between the 230 and the 76,804? Well, 230 divided by 3 is 76,796. So they have a little bit of extra cash, probably in the form of receivables here, but basically you're looking at a ratio of 3-to-1, so this is clearly a negative 3x tracker, right? So example after example, you could look at this and you can say, this is actually quite simple. Really easy to remember how these are set up. And the fund's NAV, of course, is equal to the value of their cash, remember the assets are their cash, not their futures contracts, divided by 55.75, and their NAV was 13.77. So that's what it was on that day. So the four pieces of the equation about the performance of these things are: what's the notional value of the contracts they have? How much cash do they have on hand? And that will always be an integer ratio, or very close to an integer ratio. What is the product of the two, which is the NAV, and what is the product of the two divided by the number of shares outstanding, which is the NAV per share. Then finally, what is the market price? And the only discrepancy you're going to find in there that's consistent, perhaps, is the spread between the market price and the actual INAV. The INAV, remember, is released every 15 minutes, typically, for these things, although the funds that track these things calculate the INAV every second. And there's therefore going to be a bit of a spread sometimes between the two that is cleared off by arbitrage. So when you take a look at how they track just about like you would think. This is USO versus OILD in 2019. You can't clearly see that one is going inverse 3 times the other, but it is. And it's doing so fairly reliably. Now there is a problem with these, though, and that is the fact that they disappear. This is the first time I've ever used this example, because this was the old example, and this was DNO, and data from 2016, that's because in 2017 or 2018 it disappeared off the face of the earth. These things tend to disappear because they're unpopular, and they don't get trading volume. And if they don't get trading volume, then they're on the way down. Now, I've never actually done a study about what happens in the last days of the life of a failed ETP, but there probably is some loss there. And therefore, when you trade these things, you want to make sure that you trade one that has sufficient volume to give you any confidence that it's going to be around. Now, if you're doing it day by day, you don't necessarily have to do this. But if you're going to put this thing, for whatever crazy reason you would, in an investment account, then you would never do that without making sure that it is up there on volume, because one day it may just disappear. Okay, so that's simple, right? That's really easy. That sort of financial engineering is kind of clever if you think about it. And you know how to design an ETP now. But there's a problem with these things. And the problem with these things arises under the most peculiar of circumstances. Remember I said, why would you ever buy oil, for example, for an investment account if you wanted to? Why would you do that instead of buying, say, S&P 500 stocks or whatever? You say, well, you know what? If I thought that inflation was going to be a problem, you've already said that stocks don't perform well during inflationary periods, and initially you really can't move into bonds. You can move into bonds after the inflation has happened and lock in the high rates, but at the beginning of the inflation, or when you are forming inflationary expectations, bonds are not a good investment. You can go into short-term assets like 2-year notes, but you're not going to get any yield. You just protect your capital by doing that, and that's good, but you're not going to make any return. So what could we go into is a commodity maybe that will do well during an inflationary period, and why not oil, right? Wouldn't oil do well? Or let's say choose a whole bunch of commodities like oil, gold, and a whole bunch of other things, all of them leveraged, for example. So we might choose USO. Well, it would turn out that would be an absolutely disastrous bet for the following reason. And this is what people generally don't know about. Again, this is also an important concept. 2 concepts are taken away from this lecture that are important. How these things are structured so you get leverage, and then why that leverage is not going to work for you during the investment period that you think is going to be what you want to do. Futures contracts can be used to hedge against rising prices or falling prices. But if inflationary expectations are robust and inflationary expectations are already priced into the futures contracts, there is no hedge available to you. And there is no hedge available to you indirectly by buying the ETPs that are using the futures contracts. They will not perform for you at the time you expect them to be your hedge. That's why when hedging is part of your business or investment strategy, you must either hedge all of the time, including when it may look like you least need to hedge, which involves some cost, or you have to be confident that you have an edge and you can move into the market before inflationary expectations push up the price of futures contract. So you'd either better be very, very good on your timing, or you have to hedge all the time as a matter of routine. When futures prices rise, as contracts get more distant, and say the price of oil goes up, each contract going out for 2 or 3 years, the media and analysts call this a contango. And the next couple of slides are examples of contangos. The opposite is called backwardation. If the prices begin to slide down, that's called backwardation. If they're going up, that's called a contango. Now, there's 2 benefits from knowing about a contango. One of those is if you know how they behave, then you won't make bad investment decisions when contangos are present. The other is it's an absolutely wonderful word to use in social contexts where you're trying to impress people with how much you know. It's a really, really good Chardonnay and hot tub word. For example, sitting in the hot tub, you can start striking up a conversation about copper being in contango, and that alone should impress everyone else sitting in the hot tub with you automatically, even if they have no idea what you're talking about. So it's a useful concept to know and a useful word to remember. Now, let's take a look at a very, very strange contract, the wildest trade of all times, I think, with the January 2009 crude contract. This happened over the life of this contract. This is an astonishing thing. Nothing ever seen before or since like this crazy contract. This contract started out in January of 2008 at the price of 60. It rose to an astonishing $142 per barrel of crude before the September, and then collapsed down to 40 at the time it expired. There was mountains of money made and lost on this single contract in 2008. This was a legendary contract because of the insane swings in price and the fact that, of course, traders are typically trading with some leverage of 6 or 7 or 10 to 1, and when you have these massive swings, then you're making or losing mountains of money all at the same time. This contract is interesting to us for another reason, though, that is tied to what we're talking about here. If we roll back to earlier in the year and look at this contract or find it in the chain, then we see in late 2008 we have a contango chain. This is the most contango chain that oil has ever had. All right, so you say, what does he mean by that? That's when the prices start to rise. This would happen, of course, during any formation of inflationary expectations in any commodity that would be part of that inflation picture. So you've never seen inflation in your lifetime, you're too young, but you will see it. And when you see it, one of the first indicators that it is underway will be commodity contracts one by one start going into contango, meaning that the further term prices will be higher, marginally higher, quite a bit higher, substantially higher, and then wildly higher than the short-term prices. And this is an example of that. Now, this contango was not specific to a general inflation. This was an oil contango. This is tied up with the energy crisis in California and when Enron had just gone bankrupt and all of that, right? So you can see that the January 2009 contract had a value of $43.15, and the January 2010 contract had a value of $58.78. That's a 31% spread, and that's far, far more than carry costs for this kind of asset. I don't discuss carry costs in the lecture, but I do discuss carry costs in the book. And that's if you're a trader, carry costs is when you literally go short, in this case on the January contract, by buying crude oil now and simply delivering it in January. And oil companies were doing this back then in 2008. So you say, well, how would that work? You'd say, well, this is around November 2008. How would that work? Well, because this top contract was close to expiration, then obviously spot was pretty close to 43. So if you've got a one-year contract at $58, then why not just buy a lot of oil at spot, store it, and go short in that contract and actually make delivery, right? If you're in the oil business. Remember, we don't make delivery, but if you're in the oil business, they can make delivery. It wouldn't matter if you can't make delivery anyway. You buy the oil and you store it. You're guaranteed to get a profit because the cost of storing the oil and financing that purchase is not going to be 31% of the cost of oil. It's going to be about 5% of the cost of oil. Absolutely, completely guaranteed massive profits if you can do this. So you say, well, if you could do this, then the contango wouldn't even exist. If you could do it, because that would bring the prices back into alignment. But what if you have some storage and it's accessible only to a few, but you don't have unlimited storage? And that was the situation. Oil companies who had access to empty tankers could do this, and did, but there wasn't enough storage in all the empty tankers of the world to store the oil that would be enough to pull these prices back into alignment. So those who had access to the storage made huge amounts of money because it was absolutely guaranteed. Buy the oil, put it in a tanker, sell the contract, and just wait. Deliver it literally for $58.78. Now again, indirectly, because of course the delivering for $58.78 means because of the gain you made in settlement and all of that, but effectively you can deliver it for $58.78. So if you could manage to store 100,000 barrels of oil, then you would make 100,000 times the spread minus the so-called carry cost. And again, that's the cost of storing it, right? It worked because there was limited storage. This happens in natural gas all the time, which is why I play natural gas. There's only so much storage available for natural gas as underground salt caverns. When those salt caverns are full, that's it, right? Then there's no place to store natural gas, and so if it goes into contango, it stays in contango, right? So storable commodities don't have to be stored. Can this happen for the S&P 500 index fund? It cannot happen, because you can store 500 shares of stock because it's a mere bookkeeping entry. So the arbitrage that would arise in a contango for the S&P 500 SPX is going to pull it back into alignment, and that's why SPX is never in backwardation, never in contango, is always flat, always, because it's not a storable commodity, but that's not oil. So you say, okay, let's say that you now, say 10 years from now, when you're just beginning to save up for junior's education, you say, you know, Evan said that there was going to be like a hyperinflation at some point in my lifetime. He didn't know what circumstances or so-called transmission mechanism would actually lead to that, so he couldn't give me much of a clue as to when, but he said it would happen. He said it was inevitable. And so how do I prepare my investment account so I could still get my kids not into Harvey Mudd, but possibly into Occidental, let's say. So, or Loyola and Marymount. No, not there. They're near the coast. Someplace in Idaho. All right, so the way we're going to be able to do that, you say, is to go long on ETPs that are in commodity base, because they'll rise during the inflation. And that would turn out to be one of the worst investment decisions you've ever made, because you go and buy the ETP, it's just priced. You don't know anything about it. It's just priced. It's like buying 100 shares of Ford. There's nothing about contango in the ETP discussion or literature or anything. It just says that we promise to track daily and so forth. You say, well, that makes sense. If we have inflation, it'll go up, it'll track it. But you wouldn't do that, though, if you're going on oil. You wouldn't go look at the U.S. oil. You would go look at futures contracts for oil to decide whether you would make this, because if you said, you know, this general notion that we're having inflation is becoming fairly widespread, let's see if oil is already in contango. And if it is, you have no bet. And buying U.S. oil will actually cause you to lose money during the inflationary period, even if you're right about the price of oil going up. Why is that? Because look at what they have to do, right? When we went back and saw the U.S. oil contract right here, okay? They're in January 20. They're in one contract, sometimes two. They're both short term. They're only in two because they're rolling slowly, so people can't play the roll. It used to be that people played the roll and you could make profits out of the roll, you know, because all of a sudden there's these massive inventory of expiring contracts, purchases of new contracts, you know, and so they had to get away from that, so they roll slowly. But they're still only one or two short term. So you say, okay, then what What's the problem? Well, if you're in contango, every time you buy, the next time you're paying a higher price. And here's kind of the illustration of how it works, okay? So here we have, you're a trader, and you're looking at the circumstances, and will a commodity-based ETF that invests in futures see its NAV rise if the spot value of the commodity that it tracks rises month after month? And the answer is going to be no. And so here's why. So suppose that on the day that spot is 87, looking at this going from left to right, spot is 87, this is the day we want to buy USO. But suppose the futures contract for the next month is correctly at 90 already, right? Spot's 87, next month is 90, month after that's 93, so you're looking at a contango, right? Okay, so spot's 87, you move into the contract, the nearest term contract when it's 90, your USO. Okay, so what happens if spot goes to 90 as predicted? If spot goes to 90 as predicted, what happens to the value of the futures contract? It has no capital gain nor capital loss, right? It expires at 90 because it converges to spot. It starts at 90, it stays at 90. Then you have to roll it. And when you roll it, spot's at 90, but your futures contract for the next month is at 93 because it's in contango. So you go into that one at 93. Now there's a loss of cash right there because you have to do that. You're paying a higher price than the price you just exited. Okay, suppose that the contango, in other words, is correct. It says, you know, through the futures prices, I anticipate that the spot price will be 93 in 1 month. And it is. What happens to that contract? You entered at 93, you exit at 93, there's no capital gain. Then you say, okay, we have to roll it again. Now the futures contract is 96, spot is 93. You go into it, the contango is correct, spot goes to 96, no capital gain. And so if you did this all year long and your USO, you do not make a penny of capital gains, even though you anticipated the inflation correctly and the futures market has it priced correctly and your NAV has not risen by 1 cent, right? And that's the problem. There's no way for the NAV to rise in this example. If the futures market correctly anticipates the inflation and the futures price actually becomes the spot price, which ideally it should come close, there's no possibility of making a capital gain in this trade. So the more inflation, the more the price of oil rises, the more you see it rise, you see the contango actually happening, and you look at the NAV of your tracker, it's exactly the same day after day for the whole year. It does not rise by 1 penny. It will rise only if the inflation is higher than that anticipated by the futures price. Then it'll rise to that slightly higher price and you'll have a small capital gain. So if, in other words, the contango says it's going to rise by $3 a month, and that's wrong, and it rises by $4 a month, you'll have a capital gain of $1 per month. So a small gain. On the other hand, if your futures contract anticipates inflation but overestimates it, and the inflation actually happens, then your NAV will actually go down in the investment and you'll lose money. So you can move into USO when oil is $45 a barrel. You can look and see that the futures contract a year away is $90 a barrel, and you say, man, that's inflationary expectations I've ever seen. Let's jump in. And then if inflation rises to $85 a barrel, meaning the inflation forecast was right, because after all, 40 to 85 is a big inflation price, your USO stock has declined in value by 10% because it underestimated the amount of inflation. And that's the problem. That means that these tracking stocks that are supposed to be tracking inflation, the only reason you would have something like oil or gold or copper or anything in a retirement account will not perform the one time that they're supposed to. right? You buy gold and you say, well, gold's not rising, but I don't care. It's not there for right now. It's right there for inflation. It's right there for inflation. You buy gold right now. I don't care if it's rising now. It'll be the big performer during inflation. It will if you buy GLD, the actual gold tracking stock that holds physical gold. It will not if you buy our ETP we designed in the first lecture. That will be a big disappointment. And nobody knows that about these ETPs. So in other words, the one time that it's going to perform for you is the time that it fails for you. And that's the lesson. So here's an example in case you couldn't follow it. You can kind of go back and track this if you're confused about it. Here I make up an example where I'm showing futures and spot. And so we have spot not going exactly to the future price, because remember I said sometimes it's the case that the futures price is not the same as the expected future spot price. And that kind of comes into play here. So they're not going to match exactly ever, of course. And so in this example, we have the futures contracts in contango. We have compliance with that. Spot is rising, but of course they're not matching each other exactly. So you say, well, what happens to my NAV if that happens? And so we track that. And we say the NAV actually goes up and down and up and down. Basically, it tracks out the no change when the pluses and minuses average out. So you say, oh my God, you're not required to know this, but this is a subtle point that helps you understand it a little bit. I said the futures price is not the same thing as the expected future spot price. No. If everybody's hedging, then mathematically they can't be the same because there's an insurance premium priced into the futures contract, and the value of that insurance price is separating it from the expected future spot price. So if, for example, you're a coffee vendor and you say, I think the price of coffee is going to go to $22 per pound next year, and it's currently, say, $16, and you say to a trader, will you take a short position in this so I can go long? And they say, and so he says, well, what do you think the price of coffee is going to be? And I say, well, I think it's going to be 22. And the trader says, you know what? I think it's going to be 22 also. So he said, well, will you take delivery at 22? And the speculator says, why the hell would I take delivery at 22? Right? Because I wouldn't make a profit if I do that. I'll let you trade this if we price it at 24. And so if everybody's hedging, that insurance cost is built in, and so the futures price and the expected future spot price are not the same. Now that's not something I expect you to remember, but that actually ties a lot into why these things don't exactly match up over time. So what I do expect you to kind of remember is the yellow. During times when futures contracts are in contango, then all futures are well above spot, and all go subsequently higher with duration. The contracts have to be rolled over by the ETP. Therefore, you're tending to buy higher than settlement if spot doesn't rise enough to cover the spread, and your NAV goes absolutely nowhere. Now, that's a huge design flaw in these things that's going to be discovered by people in spades when we have our first bouts of inflation in the future. There have been times, there's 2016 when they didn't track. This is WPI versus USO in 2016, and that's because we had a contango situation in oil in that year. Right now it's tracking pretty well. This is the spread track that I'm doing here, and one means they're tracking perfectly. And you can see WTI is rising about 1% faster than USO, and this is daily track. That's okay. That's not so bad. It actually brings it into alignment at the end of the year, so that it tracked okay. So you can take a look at USO and say it's tracking the spot price of oil almost perfectly. But it won't if there's inflationary expectations. That's the point. If there's inflationary expectations, it's going to do this, or worse, if there are none, it's going to do this. There are contracts that mitigate this some. This one right here, which is the 12-month oil fund that uses 12 contracts that they roll, works a little bit better for this problem than others, but these are very rare. These are very rare contracts. Okay, so there's one more thing I want to tell you of substance about this, and that is ETNs. Now, this was stressed in the appendix of the chapter I had you read, and I'm merely bringing it to your attention again. This is where I just say to people, don't buy ETNs under any circumstances, even short term. You don't know how they're collateralized. And that point was made in the appendix of the chapter. Because when you look at their prospectus, it says their inventory consists of swaps. It doesn't say futures contracts, it says swaps. And strangely enough, it says swap UBS, United Bank of Scotland, swap Bank of America, swap Citibank, and so forth. What the hell is that? A swap contract is a contract where Bank of America promises to match the performance of whatever it is you're telling it to match. And so DOG, for example, in fact, this is DOG. DOG's the short Dow 30. So the Bank of America says, I promise to settle the cash in your account exactly like your prospectus says I will. And that's the swap contract. That's the contract that Bank of America says. You say, well, how the hell can Bank of America do that? Well, obviously, Bank of America is the one trading the futures contracts. But in that case, you don't know what they're doing because they're not required by law to report that. So whereas for USO, you can see what they're investing and you can anticipate how it might go well or south. When you're talking about swaps, it's just a legal contract made with the bank, and it therefore has the integrity of the banking sector to back it. And if you live through the years 2005 to 2008, or your parents did, ask them what they think about the integrity of the banking sector for banking various assets in which they're involved. Because they triggered off a global crisis of untold proportions then on their mortgage assets. So basically we say if it's an ETN, if it's called an ETN, exchange traded note, it's swapped collateralized and it's something you don't want to have anything to do with. I also have examples in the back of the chapter on the Eurodollar swap versus the one that's secured by actual Eurodollars, and the Eurodollar note swap is all over the place, and the Eurodollar one that's secured by Eurodollars is actually tracking the currency perfectly.
What benefits do the ETNs get by being collateralized? What benefits do the ETNs get by being collateralized with swaps instead of dealing with the futures themselves?
Oh, why not? Basically, it's bank business. They charge a pretty high fee. The banks charge a pretty high fee to do it. But, you know, basically, if you want to go into business, you figure out what you want to do to go into business. You say, is this legal? And they say, well, it's not advisable, but it's legal. Then you say, okay, let's do that. And the next thing you know is you have an ETN that promises this. Now, you say, well, couldn't they do this with Dow futures? And the answer is, yeah, they could, but instead of doing it themselves, they let the bank do it, and then the bank charges a fee to guarantee them the performance, and that's a swap, you know. So why not? Come on, you all went to Harvey Mudd, and so that means you're all going to go to work for Google, Microsoft, or Apple. So you're in the culture of people who go to work for Google, Microsoft, and Apple. If you went to Princeton, you would work for a big bank. And you would all know each other, you know, as I went to Princeton, you went to Princeton, let's do a 3x inverse on an index. What a great idea. We should make $1 trillion. You know what? You work at Citi, right? Yeah, I work at Citi. Let's do swaps. Sure, let's do swaps. They do it because they all go to Princeton. I'm serious. I'm completely serious. That's why this stuff happens, right? Go, again, watch the movie The Big Short. You're assigned to do that. Those are all Princeton guys, right? That's what you learn when you go to Princeton, how to do stuff like this. And so you do it the Princeton way, just like you will do things the Harvey Mudd way at Google, Apple, and Microsoft. And I guess a few other companies hire here as well, but not very many, right? There's mostly Google, Microsoft, and Apple, so far as I can tell. Okay. That's a dead serious answer, by the way. That's the Princeton way of doing things. And so involving banks and what banks do, and you learn that as a graduate student, get a master's program at Princeton and the like. And so the Secretary of Treasury is from Princeton, and the head of the Federal Reserve is from Princeton, and the bailout was done by a guy from Princeton. And so it's like Princeton people fixing things, just like you'll fix things at Google and Apple and Microsoft, because you're part of that culture. You think I'm teasing you, but I'm not. You don't understand how the world works. This is how the world works, okay, the way I'm just telling you. Speaking about how the world works. I assign you to watch this YouTube channel right there. That's an assignment. This is, don't worry, be happy. I'm not going to hold you to this, but this is more about the options trades. This is one of the saddest things you'll ever see in your entire life, and this is linked not to the futures, but to the options. And options on futures. So you said, what, there's options on futures? Yeah, this is a trader who did options on futures, and he wrote naked puts and calls on futures contracts. He wrote this book, I have a copy, called Option Selling. I've got the one on the top with the white cover, and it's this long thing about how you make money by writing naked calls and puts. Now you may notice that I've told you not to write naked calls and puts, right, because of the unlimited exposure. It's a type of investment that they call picking up pennies in front of steamrollers, because when you write puts all the time, usually you make a little bit of money from doing it, just all the time, constantly, relentlessly, constantly. But there's a risk factor there that if you have a Six Sigma event of some kind, then you can lose a lot. And this guy lost it all. He not only lost it all, he lost it for every one of his clients and wiped every single one of them out completely. Over $100 million worth of losses. Every single client he had every bit of their cash completely lost, and they all got margin calls equal to 2 to 3 times their investment amounts. So typical investor would have, say, $1.5 million with this guy, and he's writing naked calls and puts on options, on futures contracts, and they would get nice return, 5, 6, 7, 8, 10, 15, 20%. And then one day, he posted this video, and I want you to watch the video. Now, there's analysis at the front. If you just want to watch him cry, then go about halfway through, because this guy posted the video on YouTube, which was the second half of this video. Then he sent it out and said to all of his investors, look at the YouTube, I won't be reachable for a while. And so this guy wisely pulled that down and incorporated it into his video, but has an explanation at the front. You don't care about the explanation so much. You just want to go to the second half and watch this guy talk. And you say to yourself, this is why Evan said, don't write naked calls and puts, right? And this actually happened, and it's based upon this investment strategy, a typical finance book that you can buy. And I got involved in it because a bunch of us last year were wondering about something over Reddit. The rumors started to float that a big fund had gone under. Nobody knew what it was. And so it was about natural gas, and I was trading natural gas, and I have this comment down at the bottom. So some weird shit's going on in the market right now, right? And it's rumored that somebody big is going down. I write at the bottom, the interesting point, looking at charts, I have to keep wondering, what the hell? Interesting theory, sort of an odd pairs trade gone massively wrong, and that's what they were thinking. It was a so-called spark spread, which is a paired trade between natural gas and crude. It turned out it wasn't that. It was a straight trade in natural gas. And Option Sellers wrote this, and he says, I'm wanting to give you an update on the situation here with your account. We have spent the week unwinding our short natural gas as expeditiously as possible. And so we are caught in a short squeeze. They were not caught in a short squeeze. They just screwed up. Our clearing firm requires us to liquidate all positions. Your account could potentially be facing a debit balance as of tomorrow. This has in effect crippled the firm. And so basically this is a note that all the investors got, and it was a statement saying they had lost every penny of their investment, and on top of that, they had margin calls in excess of that they had to answer, because it was an investment account where he was investing in their name on their behalf. And they went into the margin calls. So what happened was natural gas see that graph over there? Natural gas had one of those spikes. Natural gas has these 6 to 10 sigma moves all the time. And you see, that's actually a contradiction, Professor Evans, in terms. It can't be all the time 6 sigma move. Well, we qualify that in Econ 136. There actually is such a thing. And so he was short when it went up, and he had written a option on a put, and he was short. And so he lost like 20% in an hour. And what you normally supposed to do with that is you fess up. You back out, you get out of your position, you take care of your margin call, you fess up, and you tell your investors, I'm sorry, I really screwed up. I lost 20% of your entire investment in 5 minutes, right? But other people do the double up. And they say, you know what, that was a 6 sigma move, it's going to reverse, so let's do it again? And he did. And so then he lost 60%. And he said, oh my God, they don't know any of this. They'll never know at the end of the day if this reverses. If this comes down, they'll never know that we were like this. So I'm going to make one more bet. And that one took it out into full-blown, absolute, total collapse for 377 accounts, all above $500,000. Every single one of them wiped out, every single one of them with a margin call. And so, again, this in a class, you say, you will read trader after trader who says writing naked puts is a really good bet because they're mispriced and the cash kind of comes your way all the time. You just have to be careful about that occasional Six Sigma run up in the price, right? But the trouble is on the psychology of trading, and I keep pointing out to you, this is where it all goes south. You make the wrong kind of trade in that kind of heat because it does go up, you lose your 20%, but instead of taking your loss and admitting it that you're not quite the genius that everybody thinks you are, you say, you know what? This time we'll double it up and it'll go the other way and nobody will ever know we were in that position. And so you make that bet also, and that's kind of common. And the next thing you know, you're at the end of the road. Now, the bet I told you about last week, the Robinhood bet, was pretty much that same exact kind of bet, right? So this is actually one of the accounts that was posted by one of the clients. This is a trader. He actually posted his entire account on Reddit, and this is it. He lost $775,000 on these trades. Every penny he had invested was lost, and this is the account showing the elimination of all of its value plus a margin call at the bottom. So this is why you don't screw around with this stuff, right? You take these reputations that are solid, entire books written, whole schools of thought developed that this is how to make money and this and that, but they don't take into account the occasional 6 or 7 Sigma move on really highly leveraged accounts that just wipe everything out in 1 hour. In the Econ 136 book I'm assigning a book called When Genius Failed. And that's when Merton, the Nobel laureate who developed the Black-Scholes-Merton model and his investment fund, was wiped out to the last penny, just like this, by a 6 Sigma move. And in the book, he says, nobody could anticipate a 6 Sigma move, as he explained why this fund that he built was wiped out. And that's naive, because yes, you can. These markets, you don't necessarily know when they're going to happen, but you know they're a possibility. And if they're a possibility, you don't do stuff like this, and you don't write books saying it's safe to do things like this. Because for 3 consecutive years, you can have a 20% or 25% rate of return on this kind of strategy. Then the 6 Sigma move hits, and it's news-based typically, and everything is wiped out during that move. And that's what happened to this guy. This guy had been trading like this for 20 years, and then in one afternoon, everybody he traded for had everything they owned completely obliterated off the face of the earth, right? Because he was following a flawed strategy in the first place. That has nothing to do actually with the lecture on futures, except I think you find it interesting that these catastrophes happen, right and left in the finance markets. And it's because of the lack of failure to understand the downside of popular strategies, right? Popular strategies can pay off positively for year after year after year, and then boom, it just completely wipes you out because of its inherent flaw that was built into it all along. The inverse 3x ETN, that were leveraged 3-to-1, they were all wiped out by the same trade. This is one of them. There was a 3x inverse that was wiped out by the trade. So the summary statement of the danger is right here, and you can read this. It's a summary of just everything we said. I want to tell you about something topical. Well, I better stress this. You understand the actual differences between ETFs, ETNs, and ETPs, and those collateralized with futures, why you don't trust experts to advise you. The people who, by the way, professionally advise people on this don't know any of this stuff that I've told you today. They don't know it. They're not taught it, and so they have no idea that this stuff is true. So the problem that most retail investors do not know about or understand these days hazards, but they're not that hard to figure out. You understand them. Now you can go, remember I told you about shorts that they used to be funded by big institutional traders? Hey, you can participate in this now ever since this low fee stuff. Interactive Brokers is saying our stock yield enhancement program allows you to sell your stocks to shorts that you have in your free account. So if you buy 100 shares of Apple and you say, I'm willing to let somebody else short it, that's the loan you're making to other people, and they pay you this little piece of interest on your shareholding. So it's no longer the big institutional funds are funding all the shorts now. You can fund the short if you want. And the interest they pay on that's actually pretty good. It's like 5 or 6% annualized if it's a standard short, and it's like double or triple that if it's a heavy short like Tesla. So you go along and short it, and if you read the link that I have there, they'll tell you you can just sell the stock at any time too, and they'll just exit your short and just cover it with somebody else. So this was never available to small-time traders. Now it is. So I thought you would like that.
Wait, what's the drawback of that? That sounds great. Like, is there any risk involved?
What?
That sounds great. Is there any risk involved?
It is kind of great, I think. I can't think of the downside. My wife has big inventories of stock, right? And I'll say, let's transfer to Interactive Brokers. You can short it all. I mean, you're just loaning it, right? And they're guaranteed to cover it back, although it's not insured. So you have to wonder about that. It's not like a bank insurance program. Then the final thing is, I did mention this. So we bought a ton of calls on this. It'll probably lose money. But basically, this is all in, as I said, by Ford on electric. This is not just like Chevy building the Volt, right? This is a big deal. Ford's putting up 3 assembly plants to build 4 models of this electric Mustang, and this is an all-in bet by Ford on electricity that will either restore this company's fame or drive it to bankruptcy. And so we made a pretty sizable 3,000 share call bet on the winning side on this. So we'll see how that turns out, right? So just bought a whole bunch of calls, but they're not naked. We didn't write them. That's just, the most we can lose on this is what we paid for these calls. They're really, really well priced. So I went ahead and did it. So we're long on Ford right now, okay, because of this Mustang bet, electric car Mustang bet. Okay, that's it. We do real estate next, so you can really figure out how to pay Junior's college admission. Just buy 5 houses along the California coast, and you can send your child to Harvey Mudd.
Doesn't it come out in like 2021 or 2022?
It's coming out in February 2021.
Okay,
Yeah.
so in like
Yeah, so it may not react until then, but I think that people will assess. It is a true technology all-in bet.
Yeah.
You know, as soon as you think about it, you say Ford's going all electric with this bet. You know, because it's like 4 assembly plants. It's their main model. It's the only thing that matters aside from that for them is the F-150, and they're going electric on that. So.
well, I mean, like I was thinking about that and like whether to go long or short it, because I feel like Mustangs or like people that might buy Mustangs even
Yeah.
like muscle cars. They don't like SUVs that are electric.
I don't think that matters, you know.
Don't think so?
Yeah, because that's been the complaint. Why you call it a Mustang? That's a different, you know, it's a different lineup. I kind of like it because when they introduced the first Mustang, it was a massively important decision, right? Because the design of that car was very unique for the time.